I was talking to a friend of a friend this past week, and the conversation did not go well. It was a woman, though that has nothing to do with the conversation. But I was talking to this woman, and she was talking about her portfolio, her stock market portfolio, and she doesn't know me from anyone. She's like, "Oh, well, I do this smart thing, and I diversify my portfolio to make sure that I get the best of the market." And anyone who knows me knows that the word diversification is a trigger for me. And I was like, oh yeah, diversification. People often think that diversification is what protects their money, but actually that's not true. And you could see her starting to look at me like, who is this guy? And then I said, if you ever actually looked at all the major corrections in the stock market going back 50 years, the one in 2008 for 50%, the one in 2011 for 20%, the one in 2000 for another 50%, the one in 1998 for 25%, the one in 1974 for 50%. I said, you'll notice that diversification actually did not help you. Now, the problem with beliefs is that and let's just say what I was saying is true. It is, but let's just say that is true. The problem with someone's beliefs is facts don't alter somebody's beliefs. And so I was saying this to her. I said, really, that diversification you have is a tax on your future. It's a tax on your choices. It's a tax on your life. You just don't know it. Well, look, that conversation did not go well. But I used a different approach, and I said the following thing to her, and she looked at me even weirder. I said, it's almost like you're in New York and you want to go to San Francisco, and you're driving across the country, in this metaphor, and you're driving across the country with one foot on the gas pedal and one foot on the brake, because that's actually what you're doing. And, every so often you have to pull over and get new brakes. But you think that's normal because everyone else is doing it. That didn't seem to work with her either. So I gave up. I went to go get a drink, and we did not talk about money again. Hey, everybody, this is RC Peck. This is my weekend podcast. And the theme for this weekend, I'm going to call it 100% chance of, and you can just put anything past that. But the image that I want to share with you for this podcast is the image of the majority of people on this planet growing their portfolio by having one foot on the gas pedal and one foot on the brake pedal. And I could say that the two most popular ways of driving your portfolio this way is to A, be diversified across all different asset classes that get rebalanced every year, because there's certain asset classes that historically underperform. So if you are always allocated to them, it's like having a foot on your brake. And then the other way is to always have money in bonds, right? Because that's another thing that people often believe to be true, even though it's not. They say, well, if the market falls, then I'll have some bonds to cradle or soften that fall. That part is true, but it's almost like, hey, there's going to be some curves in the road, so I'm going to have my foot on the brake and just have some pressure on it in case a curve comes up, regardless of whether you can see it coming up miles away. So with that, I want to share a really scary idea with you this week. I'm not going to show you any price charts because you know what? There's nothing to report. The S&P 500 is still up and out of its 2-year channel. As long as it stays above 2100, there is absolutely nothing to report. Gold is still in a new bull market. It is correcting, though not that much. There is still nothing to report there. Bonds are still in a 35-year bull market still. There's nothing to report there. So there's really nothing to report. So the question is, what do I want to share with you? So what I want to share with you is this idea of 100% chance. So there's a 100% chance that we are going to have a recession in our future. And I know this because we've always had recessions. Now, going back, I look back over the last 70 years. And on average, we have a business recession in the United States every 6 years. And the longest we've gone between recessions is about 9.5 years. Okay, well, we got out of a recession in 2009. Let's say mid-year 2009. So we got 2010, 11, 12, 13, 14, 15, 16. So we are now 7 years into a no recession right? And the average is 6, so we've now surpassed the average. And the longest we've ever gone without a recession is right around 9.5 years. So we could go another 2.5 years. Now, it doesn't mean we have to have a recession in the next 2.5 years. I'm simply pointing out that we have had a recession on average. This is not spinning. This is just actual data. Every 6 years on average. The longest between recessions has been 9.5 years, and we're at 7 years. So historically and statistically speaking, we're due for a recession kind of any time. Not like tomorrow because we can see things coming ahead. But, we will expect a recession. Now, why does this matter and why am I talking about this? Well, I'm talking about that because of the price chart on the screen here. And the price chart is the federal funds rate going back to about 1954. And this is what the Fed, the interest rate that they are in charge of, called the federal funds rate. Now, those gray vertical lines are recessions. I want to point out two things to you on this price chart and why there should be a level of attention on this, though not necessarily acutely. So notice during each gray line, the central bank of the United States, also known as the Fed, lowers interest rates, right? Lowered them right here in about 57. Here they did it again in 61. Here's one in 1970, then in 74, then in 80, 82, 92. That's probably more like 91, 2001, and 2008. So we know, and this is true even going back before 1954, we know that when we go into a recession, the Fed lowers rates. And the average they've lowered rates is 5.5% or 550 basis points. Now, this is the average of what they've lowered. Our rates are basically at 0, right? Yes, I know they're at 0.5%. But if if the Fed follows their same game plan, that means at the next recession, the federal funds rate is going to be negative 5%. Now, I know this sounds ridiculous. I'm just showing you what the Fed has dropped their rates each time we've had a recession. I'm just telling you how often we've had a recession, historically speaking. Now, I don't know if we'll see negative 5%, but there's a very, very high chance, let's call it a 100% chance, that gold will skyrocket. The price of bonds will skyrocket because the price of bonds and the yield of bonds, the yield, move in opposite direction. And it's also likely, though we'll see because there will be a lot of instability, that the stock market could cruise higher. Though it could be crashing because we don't actually know, because we've never been in a situation like this. Here's my point. We are still in unstable times. The stock market itself is still in what I call a contraction cycle, and we've been in that since November of 2000, and we're not out of that yet. I don't know what's going to happen. The Fed is kind of sending smoke signals saying, look, we're not afraid to go negative. And I doubt they will go negative until there is a recession. But there's a very high chance. I wouldn't call it a 100% chance because we could go 10 years without a recession. Maybe we could go 11 years without a recession. But now we're really into historic abnormalities here. Abnormalities? Okay, so that's the first thing. Now, here's the thing. When we go into a recession, and look at this price chart here. This is the 4-week moving average of unemployment claims. Now, when we go into a recession, notice what happens to people losing their jobs. It goes up. Here it goes up, right? It's going to go up every time, guys. 200,000 initial claims to 350,000. Okay, this one starts at about 250,000, goes all the way to 550,000. That's over 100% change. And I went through each one of these, and each one, the claims go up at least 60% and can go up over 100%. So that means when we do go into the next recession, unemployment claims are going to go somewhere between 60 to 100% of where they start. And if you look at this screen, you can see that the world of unemployment numbers doesn't stay below that 300 that often. Most of the time, initial unemployment claims happen, they're staying above that 300,000 mark. Now, we're below that today, but there's a 100% chance that we will go into a recession. There's a 100% chance that when we do, unemployment claims will significantly go up. And there's a 100% chance that when this does happen, the stock market's going to fall somewhere between 30 to 50%. And that's simply just what has happened in the past. Could it be a slightly better? Could it be slightly worse? I don't know. But we do have that in front of us. Now, when's it coming? I don't know. But this is what the Fed is doing, right? The Fed is lowering interest rates. The Fed is looking at the stock market. The Fed is making their choices based on the stock market because they're certainly not basing it on unemployment. They're certainly not basing it on GDP growth, which is right around 2%, which of course is not the 3% or 4% that anyone would love, but we have a positive, slowly uptrending GDP growth. Now here's the last thing. This is a price chart, and this is kind of weird, so let me just describe what you're looking at. This price chart goes back to 2008. The blue line, which moves in kind of a bitmapped way, is the Department of Labor Statistics CPI, inflation. It's inflation. So this is the government, or you can call it. I was actually going to make a joke there, but I won't. So look at this right here. The government says that inflation is right around at 0. Now this price chart is old or older, but just I have a point why I'm showing this to you. This is where the government says inflation's at about 0. Okay. The red line is MIT's BPP, Billion Price Index, where they look at the prices of things online. What you buy does not need to be online, but there needs to be a price of it online. And according to MIT, inflation is negative. Now, the only reason I'm showing this to you, and I'll tell you the reason why, if the government thinks that inflation is either negative or close to 0, that gives them cover to do more printing. Now, even though the first $3 trillion they printed didn't help, I don't think it's actually going to matter. But this is the world we live in, and it doesn't mean that you have to lose money. So here's the takeaway. Here's the takeaway, and I know takeaway, and this weekend I know is a little different. But here's the takeaway. First of all, get a strategy, not a strategy that you can kind of be like, well, my strategy is I'm diversified. That's not a strategy. That's an idea, a broken idea from the 50s, by the way. Get a strategy, and make sure you have a strategy that has a checklist. What's your checklist? Write it down. Prove it. Show it. Black and white. Does it work? Have a strategy that has clear signals when you should start to pay attention. Because look, guys, most of the time, you don't need to pay attention. But when you do, you really have to pay attention. I've done the numbers. I've looked at the market over the last 120 years. 78% of the time, the stock market is in a stable uptrend. It's that other 22% that really crushes people. So have the signals. Know when you should pay attention and know when you shouldn't. Because really 80% of the time, the market is just going to do what it needs to do, which is grow and protect your money. And then lastly, have a strategy that is indifferent, that doesn't care. Market going up, market going down, market going sideways. I don't care. What's the leading sector today? Oh, it's technology. I don't care what the leading sector is. Oh, the leading sector is biotech and technology? Okay, I don't care. I guess it's those two. So have that indifference, have that agnosticness in it, and that will help you. So guys, there is a 100% chance we're going to have a recession. There is a 100% chance the Fed is going to lower rates when we have that recession. There is a 100% chance when we have a recession, unemployment is going to go higher. There's a 100% chance when unemployment goes higher that people are going to miss their payments on their cars. There's a 100% chance that when the stock market enters into that recession, it's going to start falling 30 to 50%. This is just stuff that's already happened and it will happen again. The question is, do you have a strategy that's ready? Do you have a strategy that can protect you from the annoyance of pick of the day, pick of the week, pick of the month newsletters, from the zero hedges out there that can keep your brain calm and keep your focus on what really matters, which most of the time is doing nothing. But when you do need to do something, really do it. Hey guys, thank you for being in my world. Thank you for being in my life. This is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck.